Happy noon, everybody. Cinco de Mayo. Wonder if all of you are out there maybe celebrating a little bit early this Friday, especially since the market has been grindy right now, stuck in a very tight range. But I want to welcome everybody to Strategy Now here at MarketStream.live. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. I wanted to talk about a strategic approach that you can take going into these French elections this weekend. And really how I want to approach it is using two ETFs that focus on a currency, the euro, and European stocks. And the setup is going to be utilizing options. So for those of you that are new to options, this may be a little bit over your head right now, but you're going to get the concept. And what we want to do is we want to take advantage of what looks to be a outcome that the market in general is basically anticipating, meaning a French victory by the centrist candidate Macron. Macron is a centrist, basically stay in the union, believe in the currency, so on and so forth. The other candidate, Le Pen, right-wing nationalist. So, with this being said, and with the wide margin of victory right now in the polls, obviously they still have to vote. But if you were thinking, all right, the bullish case is still in play for Europe, how do I play this election though? One way you could do it is look at the ETF FXE, and which tracks the euro currency, and then the ETF FEZ tracks the euro stocks, the top 50 European stocks. Really cool. We're going to show you how you can do this. So I'm going to jump on the trading platform, and what I want to do is I want to take a look, and how we're going to do this is that the euro has been very bullish. As a matter of fact, let's just take a look at the charts before I even jump into the trade, how I get so far ahead of myself, right? The euro currency has been moving to the upside very nicely. You can currently see that the FXE is trading at 106.47. This is the proxy for the euro currency, this ETF. Now, you can see it's bounced off its 20 and 50-day moving average right here, 103.50, and is now trading at 106.47. That's the highest that we've seen basically in the last 3 months. So with that being said, and with the positive outcome, maybe the bullish nature of the currency might take a little bit of a back seat, right? The shorts were being squeezed going into the first part of the French election, which you could see here, that's this gap, right? Took its 20, 50-day, so the short-term and intermediate-term bulls are in control, and then recaptured its 200-day moving average. That's that black line. So the long-term bulls are now breathing a little sigh of relief. So you're thinking, well, once this outcome occurs, maybe the euro might pull off a little bit. In other words, get a little bit more bearish. Okay. Now, that may be negative for the currency, but it's going to be positive for European stocks. FEZ tracks, it's called the Euro Stock 50. It tracks the top 50 stocks in the, throughout Europe, and it trades it as an ETF. This is a real nice product. You can see after the initial vote on April 23rd in France, the FEZ popped and went from 36 to 38. Nice bounce. Had another bounce in the last two sessions. Obviously, we're seeing that the margins that are coming out in the polls for the centrist candidate, Macron, have widened. They're 62 to 38 right now in favor of Macron. Again, we won't know until noon Sunday. Now, with that being said, though, if the euro gets a little bit weaker, that'll be a potential catalyst for the bulls for potentially more upside in these large cap stocks that are represented in the FEZ. So let's put on a strategy where we have fixed risk and we're going to have fixed return, and we're going to be able to participate in this without having huge buying power reduction as far as deploying the strategy. How do I want to do this? Well, I'm going to do this using a spread strategy that I call, it's a poor man's covered put, cover call strategy. So instead of buying the stocks outright, in other words, buying shares and then overlaying an option strategy, I'm going to use long options as proxy for my short bias and my long bias on the two products. So we'll start with FXE. And really what I want to do here is what I mean by a proxy is, instead of selling short FXE, maybe I have an account where I can't do it, like an IRA or some sort of account that I'm not allowed to be naked short stock. Or I just don't have the buying power. I can't sell 100 shares of $106 stock because FXE is trading at $106.46. So you would need well over $10,000 to short this stock. So what do? Well, you buy puts, okay? And I'm going to look out in the expiration cycle June. Why? Well, for two reasons. One is the implied volatility is it running at 10. That's relatively low in terms of what's running at the front month, which is more like a 14, 13, 15 type level. So you see that the implied volatility is actually very high in the front month. Well, that makes sense. We have a binary event, the elections. We have not only an election in France, we have an upcoming election in the UK, we have state elections in Germany, and then down the road, we're going to have German elections. So there's a lot of politics going on in the continent of Europe. So in this case, what I want to do is I want to buy a proxy. So how do I determine the appropriate proxy? You're going to look at an option that has about a 70 to 80 delta. And again, for those of you that are new, all this delta number tells me is how much this option will track the underlying. So in other words, if FXE goes down 1 point from 106 to 105, this 110 option right here, this 110 option will track it 81 cents. So in other words, this put option will increase in price by 81 cents. So it tracks 81% of the total move of the underlying. So in this case, I'm going to buy this put. So one click. Now I'm going to look at the May weekly options that are going to expire next Friday. And the strike that I'm going to sell is going to be somewhere between 40 and 50 delta. So basically I'm looking at the 106.5 to the 106 puts. The reason why, I want to get maximum value both in terms of volatility as well as premium. What do I mean by premium? Well, when you sell an option, you get to keep that premium. If I sell this 106.5 put, I collect 65 cents. That 65 cents offsets my purchase price of the 110 puts. If the underlying FXE stays at or above 106.5, that means that I will basically be able to keep the premium that I just received, and I will potentially recognize a profit by next Friday. Okay, if FXE stays at or even dips below and goes below 106.5. Now, again, if you want to give yourself a little bit more room, you could sell the 106 puts, but that's going to increase your capital expenditure on the puts that you're purchasing. So what am I doing here? I'm going to buy one of the June 110 puts. I'm going to sell one of the 106.5 puts. That basically is capping off my profit point between now and the May expiration next Friday to roughly around 106. After that, I'm going to stop making money. As a matter of fact, I roughly have a profit potential of right around between $35 and $55, actually $45 and $55 per contract till next Friday. That's roughly a 15% return on the $300 that I have at risk. Now, I always put limit prices on these particular strategies, so I'm going to click limit. And I'm going to put in a price. It's currently being offered at $310. I can put it in for $310. I would probably have worked it a little bit earlier at a lower price. So basically what I'm saying is I'm going to buy this spread for $310 per contract. My maximum profit potential is right around $50 by next Friday. How am I going to manage this trade? Well, if I'm filled at $3.10, I'm going to watch very intently the French elections. If the euro starts to come down, and you can see that I was filled at $3.10, I probably should have worked it more at the 305, but I wanted to show how it got executed. Now what I do is I actually have a short position on the euro currency between now and June expiration. And specifically, I have a profit opportunity if we stay at 106.5 or lower, I'll have a profit opportunity of basically making 10 to 15% over the next 7 days on the $300 that I have at risk. Now, what happens if the euro maybe stays flat, maybe even goes up? How do I offset that risk? Well, let's go back into trade, and I want to put the other component of this, which is getting long European stocks. How do I do that? Well, because most of the stocks over that trade over in Europe don't have what we call ADRs, or American Depository Receipts, and so in other words, they trade here in the U.S., I'm going to use an ETF called FEZ. Now, FEZ is that Euro Stocks 50. As we saw, it's in a bullish trend, much more bullish than what we've seen in the euro currency. So what we want to do is we want to use what's called a poor man's cover call. The underlying is trading at $39.56. I do not want to buy 100 shares and put up $3,956. So how can I track about 80 to 90% of the underlying movement and still participate without putting up a fraction of that capital? Use in the money options. Specifically, again, you click the delta, you go into the June expirations. So that gives me about 42 days left to expiration. And I'm going to look for basically the 80 to 90 delta, anywhere between 70 and 90 delta. So you see the 39 calls are at 66 delta. So that means for every point that the underlying moves right now, I'll pick up 66% of that move. The 38s are at an 83 delta, and so on and so forth. In this case, I'm going to get a little more aggressive, and I'm going to actually pick up the $36 calls. And those are 99 delta. So they're basically almost 1-for-1 with the underlying. You could probably roll these up. Maybe we'll look at the 37s. Let's do that. That's got a 92 delta. So I'm going to buy one of those, pay $2.85 or $2.85. Now, most of you know that I don't like to buy options outright. And the implied volatility on the option I'm buying, by the way, is 15. Okay? The options volatility in the that are expiring in the weeklies, in other words, next week, are running in the mid-20s. And so in this case, what I want to do is I want to sell an out-of-the-money option, or close to an out-of-the-money option, a delta of between 40 and 50. Now, in this case, I could look at selling the 39.5s, which are the at-the-money delta, or the 40s. I'm probably going to look at the 39.5s. I'm going to be a little more aggressive here. Now, the struggle that I have is that the bid-ask spread is pretty wide, 15 cents, 10 cents, but you can always put a limit order in there. So let's review what I'm actually putting in. I'm going to buy one of the in-the-money June calls, so that gives me 42 days to be right. I'm going to buy one contract. I'm going to sell one of the May calls, the 39.5 calls, collect some premium. Those expire next Friday. If the underlying stays at, around, or relatively close to 39.5, I'm going to recognize a profit, specifically right around $35 to $40 by next Friday. Even if it does go up, I'm still going to recognize a profit in this underlying. It's like a covered right where you buy stock and sell a call against it. My proxy, or my underlying in June, the 37 calls, is covering my May 39.5 calls. I want to do this for a limit price. Let's say I'll do this for $2.30. It's currently trading and offered at $2.35. Review the order. And so basically what I'm doing here is that I'm placing an order where I'm going short the currency, long the stocks in the European Union. I'm basically trying to take advantage of the increased implied volatility on both those underlyings in the front months, and my bias on short the underlying currency for the euro and long the overall European market in stocks. Now I'm working this, it's $2.35 offer. I'm just going to work that. If I get filled, then I'll manage it accordingly. All right, folks, that is it for Strategy Now. That's how I'm playing the French elections. Stay tuned. I will be back in about an hour and a half. Exactly, I will be back at 3:30 Eastern Time. I'm going to be doing Tech Talk. I'm going to cover some different underlyings and give you some estimated moves. I'll take a look at the French ETF, give you an estimated move going into the elections. And then I'll look at some stocks that are going to have some earnings next week. And we'll look at the charts and the options and give you an estimated move on all those stocks going into these events. See you then.